Welcome to Earnings Recap. Today we're summarizing PayPal's first quarter 2025 earnings conference call.
That's right. PayPal, ticker PYPL on the NASDAQ, they dropped their Q1 results back on April 29th, 2025.
Yep, and we've gone through the earnings presentation, the press release, all the materials. And our mission today is really to, unpack how they actually did in the first quarter. What's their strategy looking like now?
And what did management actually emphasize on the call about the future?
Exactly. So, okay, let's dive in.
Well, first off, it seems like they had a pretty decent start to the year, despite, mentioning those global macro uncertainties.
Yeah, the numbers definitely show some positive movement. Let's look at the top line first. Net revenues, up 1% year over year. $7.8 billion.
Right, and that's 2% if you adjust for currency effects, so a little bit better there.
Okay, but here's something I found interesting. Transaction margin dollars, their TM1, that jumped 7% to $3.7 billion.
That's a key metric for them. And even if you take out the interest they make on customer funds,
it's still up 7%, $3.4 billion.
Exactly, which kind of suggests the core payment processing itself is getting, more profitable.
That makes sense. Focusing on that core profitability seems pretty crucial long term.
Absolutely. It's seen as maybe more sustainable than just relying on interest income,
Right. And the profit figures really back that up. GAAP operating income, a huge jump, 31% to $1.5 billion.
And even non-GAAP, which smooths things out a bit, that was up 16% to $1.6 billion. Solid numbers.
Definitely solid. And the margins expanded quite a bit too. GAAP operating margin. What was it, up 447 basis points?
Yeah, landing at 19.6%. And non-GAAP saw a good bump, too, up 257 basis points to 20.7%.
So over 4.4% increase on the GAAP margin alone. That's pretty significant operational improvement.
It really is. It likely comes from, a mix of things. Better efficiency in core processing, like we said, but maybe also that price to value thing they mentioned for the PSP segment, prioritizing better margin deals there.
Ah, right, the payment service provider part. We'll probably touch on that more.
Yeah. But anyway, that profitability flows right down to the bottom line. Earnings per share looks strong.
Very strong. GAAP EPS up 56% to $1.29. And they even noted a small boost from strategic investments in there.
And non-GAAP EPS also looking good, up 23% to $1.33. So profit-wise, a good story.
Definitely a good story on the profit side. But, you also have to look at the volume, right? How much are they actually processing?
Good point. Total payment volume, or TPV, it increased 3%, came in at $417.2 billion.
Okay, still growing, but maybe not that sort of explosive tech growth we sometimes see. 4% if you adjust for currency.
Right. And here's a bit of a twist. The actual number of payment transactions. That went down 7% to 6 billion.
Down? Okay, but wait, there's a footnote there, isn't there? Excluding PSP.
Exactly. You exclude that payment service provider segment, and suddenly transactions are up 6%.
Okay, so that paints a different picture. It really seems like they're maybe shifting focus within that PSP world, letting go of some lower margin volume, perhaps.
That's what it suggests, yeah. Aligning with that price to value strategy. Focus on the profit per transaction, maybe not just the raw count.
Makes sense, like focusing on the higher margin items in the store.
Pretty much. And that shows up in the engagement metrics, too. Transactions per active account, TPA.
Down slightly overall, right?
Yeah.
1%, 59.4 on a trailing 12-month basis.
Yeah, but again, excluding PSP.
Let me guess, up.
Up 4%. So the core users, the ones using PayPal directly or Venmo, seem to be transacting more often.
Okay, so engagement from the core base is actually increasing. That's a positive sign.
Definitely. And they are still adding users. Active accounts were up 2%, hitting 436 million.
And they added 1.5 million sequentially in the quarter. So the user base is still expanding.
Yep. Provides that foundation for growth.
Now, what about cash? How's the cash flow looking?
Pretty healthy. $1.2 billion from operations. Free cash flow was $1.0 billion.
Okay. And they mentioned an adjusted number too, something about BNPL receivables.
Right. Buy now, pay later in Europe. Adjusting for the timing of those payments owed to them, adjusted free cash flow was stronger at $1.4 billion.
So they're definitely generating significant cash.
Which gives them flexibility, right, for investing, maybe M&A, or returning capital to shareholders.
And they certainly did that. $1.5 billion returned just in Q1 through buybacks. That's about 19 million shares.
And over the last year, a whopping $6.0 billion back to shareholders, repurchasing around 86 million shares.
Wow. And they're sitting on a decent pile of cash too, right? $15.8 billion in cash and investments.
Yeah, against about $12.6 billion in debt. So financially, they look pretty solid. Those big buybacks often signal management thinks the stock's a good value.
Right, a confidence signal. But despite all this good news in Q1, they kept their full-year guidance the same.
They did. They pointed to, the ongoing global macro uncertainties, so they're playing it a bit cautious, it seems.
So for the full year, they're still guiding TMO growth of 4-5%, or 5-7%, excluding that interest.
And non-GAAP EPS between $4.95 and $5.10. So basically acknowledging the good start, but not raising expectations for the whole year just yet.
Okay, fair enough. So what did the CEO, Alex Chris, have to say about all this?
He sounded pretty upbeat, called it a great start to the year, said the strategy is working.
Okay. What parts of the strategy did he highlight?
Well, he pointed out it was their 5th straight quarter of profitable growth. And he talked about progress in sort of 4 key areas. Branded checkout, PSP, omnichannel, and Venmo.
Right. And the big picture vision.
To be the leading commerce platform connecting consumers and merchants globally. Pretty ambitious.
Definitely ambitious.
Yeah.
Did they talk about specific initiatives, like from their investor day?
Yeah, they touched on those. Driving that profitable growth, we saw the TMO numbers. Executing on the strategy, especially branded experiences, TPV there up 8%.
And branded online checkout TPV up 6% if you exclude Leap Day. Focusing on making PayPal more visible, more chosen at checkout.
Exactly. They also mentioned scaling that new checkout experience. It's now on over 45% of U.S. transactions.
That seems like good progress. And Venmo.
Big acceleration there. Revenue growth hit 20%. And Venmo debit card TPV up over 60%.
60%. Wow. People are really starting to use Venmo for more than just PDP.
It certainly looks that way. They also mentioned adding about 2 million first-time PayPal and Venmo debit card users just in Q1.
Okay. And that PSP segment contribution to profit growth.
Yeah, they highlighted that it increased meaningfully, even though the overall TPV growth in PSP slowed down, which again ties back to that price-to-value focus.
Right. Profitability over pure volume. What else? Omnichannel.
Making progress there, connecting online and offline.
Right.
And something interesting on the crypto front.
Oh, yeah. What was that?
They added Solana and Chainlink to the wallets, PayPal and Venmo, and they're enabling rewards for people holding their stablecoin, PYUSD.
So deepening their involvement in the crypto space. Yeah. That's noteworthy.
Definitely. And they also talked about selling their suite of value-added services, leveraging the platform, building beyond just e-commerce, scaling high-converting checkout.
Lots of different levers they're trying to pull. Do they give specific examples?
A few, yeah. Optimized debit routing with Wayfair and Upwork. Advanced fraud protection with Regal Cinemas.
Okay, so showing traction with major clients.
And they even mentioned launching something called a remote model context protocol server for agentic commerce. Sounds very future-focused.
Agentic commerce.
Yeah.
Okay, definitely forward-looking tech investments there.
So the overall message from management was strong platform, delivering profit, transforming strategically, lots of growth drivers, branded, checkout, Venmo, Omni, PSP, next-gen stuff.
Got it. So based on all that, what do you think analysts were likely drilling down on in the Q&A? We don't have the transcript, but we can guess, right?
Absolutely. That transaction margin dollar growth, especially X interest, you have to figure that was question number 1. Is it sustainable? What's driving it?
Yeah, definitely. And the TPV growth versus the transaction count difference, especially that PSP divergence, they'd want to understand the dynamics there for sure.
Right. And how are those big strategic bets paying off? The new checkout, the crypto integrations, what's the actual impact so far?
And why keep the guidance flat after such a strong Q1? They'd be pressing on the macro concerns, any potential headwinds management sees.
For sure. Venmo's performance and future potential, always a hot topic. That accelerated growth, the debit card usage.
And the PSP profitability, digging into that price-to-value strategy and its impact.
And finally, those massive share buybacks. Analysts always want to understand the capital allocation rationale. Why buybacks over other uses of cash right now?
Makes sense. Those seem like the key pressure points based on the results they shared.
Yeah, it all ties together. The margins, volumes, strategy, guidance, capital return. That's the core of any earnings call discussion.
Okay, so wrapping this up then. Our deep dive shows PayPal had, well, a really strong Q1 2025. Significant profit growth, definite progress on key strategies like branded checkout and Venmo.
But management is still, cautiously optimistic, maintaining that full-year guidance signals they're keeping an eye on the wider economy.
So a final thought maybe for you listening. It's interesting to watch how PayPal is balancing that push for transaction growth against the drive for higher profitability per transaction. Where does that equilibrium lie?
And how will these investments they're making in new tech, user experience, crypto actually shape their place in the, let's face it, constantly changing digital payments world? Plus, what does that continued heavy spending on share buybacks really tell us about their outlook and where they see the best value? Lots to think about.